But that require extra skill. That require extra work. That require a proper platform, which traditional unit trust agent do not have access to.
Yeah.
And investor or unit trust agent just a lot of times still thinking that my job of selling unit trust is to sell unit trust. You see, company launch a Japan equity fund, I sell Japan equity fund. My job is to sell, and my job ends after I sold, and I earn the 5% commission.
Yep.
That's it. But that is not really getting the client anywhere, because the client
Before we begin the podcast, have you gotten your free ebook? It's called the Build a Six-Figure Portfolio Guidebook. Now, inside it, we share with you the tips and tricks to bring your stock investing skills to the next level. The best part, it's only 10 pages long and it's totally free. Whether you're on Spotify or YouTube, the link to download is in the description, or you can go to www.firl.co/FREE or www.firl.co/free. Hello everybody. It's been a while. Welcome back to the FIRL podcast, best place for long-term stock investors. Today we're going to talk a lot more about stocks, and we have a legend in the house in the financial planning industry, right? Mr. Yap from Whitman Advisors. Did I get that correct?
Whitman Independent.
Yes, very sorry. Whitman Independent Advisors.
Yes.
They've been in the business for very long, and what I am very impressed about Mr. Yap is the amount of public content that he puts out. So without further ado, welcome to the podcast, Mr. Yap.
Thank you for having me, MJ. So this is my first time having this kind of recording.
Yes.
So I really hope I can enjoy it.
Glad that we are maybe the first non-radio people to interview you. But look, I want to get straight into it. I think most people who follow you know that you write a lot. You've written many books, too many to mention. And but I want to start by actually understanding you personally, right?
Sure.
Your history when you're young. I think that's something that I have to dig quite a lot to find out. So I think I decided to stop digging and just ask you straight away lah.
Okay, sure.
Yeah. So when you obviously you're the money guy, right? But when you were younger, were you always like that?
I must say that I'm not. Okay. I do not appear to be like someone who have strong interest in money. When I was young, talking about saving money, talking about how to make money, or how to work, to get more money. No, I'm not that type. But I guess something about me is that when I was growing up, my parents, even though they are like, especially my father, who's like worked for people before as a salesperson, then eventually he set up his own business. But somehow he does not seem to be very good in managing finance. Yeah, so which will say he does not save so much money when he could make more money. So when times are bad, he got really badly hit. So he always faced cash flow problem, having difficulty to pay the creditors and things like that. So for that matters, I think when I grow up, I think somehow maybe subconsciously, I always feel insecure. Having to move to one place to another place and not knowing that maybe how far this kind of life will go on. And then eventually I managed to get to Form 5. I completed SPM. So I want to go to university. I mean, I got a place in a local university. But from my parents' way of managing money, they don't really have the kind of money even for me to go to local university.
Right.
And a relative helped me to apply for a scholarship at this Li Yan Nian Foundation. I do not know whether much people know about him. And I got the scholarship from this foundation.
Okay.
And I think I want to mention about his name.
Yeah.
Because he is the founder and the developer who developed this OUG Garden.
OUG Garden?
Yes. So he was a big time
I
tycoon.
go there quite often. Sri Pataling there, that area, right?
But when I got the scholarship, he was there, I think long passed away already. So, but I have to say, without his scholarship and financing, I would not be able to pull through my university.
Wow.
So that's why I say maybe it's the kind of inner motivation into me to want to get the kind of security. That's why when I started, after I got into work, I started to, when I got to know about finance, I become very interested to see how one should plan finance very well.
I see.
Okay, and then how I get myself educated along the line.
Right. So, see if I summarize it correctly. So you saw what your dad was a business person, but he couldn't manage his cash flow properly.
Yes.
That created a bit of fear, insecurity, right? About like, will I have enough going forward?
Yes.
And so that spurred you on to think about money. And of course, you've got Mr. Lee, who very nicely, and kindly, finance your education.
Yes.
So, but before getting into the world of financial management, right? What do you study actually? At school?
I study a business management degree.
Okay.
Not too much on finance, on investment. So in fact, I'm so happy that I managed to graduate with a first class honors in the university. So after I left the university, I want to always want to make a difference. Despite that, I do not make too much money from my father or my parents. I want to make a difference.
Right.
So I joined a corporate company to provide training. Okay, to be trained as a trainer to train the employees on problem solving, decision making, customer service, and so on. But after a while, I found that there is I think I'm not getting the kind of result that I intend to achieve. Okay, because why? When I was conducting the training, I find myself very excited. Feeling like I have made a lot of impact. The participant also reacted and participated a lot during the training. So I say I have done a lot. I have achieved something significant. But 6 months later or 1 year later, when I went back to the company again and to conduct another training, then I discovered that they do not really practice much of what I say.
Yeah.
Then I start to think that if I repeat my life, giving training 1 time, 2 times like this for the rest of my life until I retire, there's very little impact that I make in people's life.
That's true. That's
where I started searching to see that is there anything else that I can do, whereby I can really, maybe quite slow, 1% at a time, but I want to make significant change to the particular person or to the particular family. So that's where I got to know about financial service industry.
I see.
Read about insurance, read about estate planning. Of course, like many people, I got to read Robert Kiyosaki's
Of course.
Rich Dad, Poor Dad.
Yeah. We will talk about him later on. I know you talk a little bit about him in your new book.
Yes.
But what was the transition like? Because obviously you're corporate, and if you want to become an advisor, you are sort of like a mini business owner yourself, right?
Yes,
in a way.
Self-employed.
Yeah, self-employed, right?
So what happens? I work about 4.5 years. Then I resigned, for a full-time job. Then I bought a franchise from Rockville to do will training.
I see.
To do will writing services. At that point in time, I still remember, I think I'm easily the first 100 franchisee they have recruited then.
And today they have how many?
I think there are 5,000 to 10,000.
Wow. Okay.
So I still remember at the point of time, I think 20 years ago, maybe then, this will writing service is not as common then. Many people go to lawyer to write wills. So that gave me a lot of opportunity and platform for me to go to different associations, different companies to give talk, and then from there generate client leads for me to provide will writing services.
I see.
Yeah. Then after that, I got to know about insurance business. I also joined it for a while, but I discovered that is really not my cup of tea.
I see.
Because I discovered that whoever want to do well in insurance business, some may have education, and some people who do not have education can do better than those people who are more educated. So I say, hey, this is definitely not the area or the territory that I can shine.
That is, correct me if I'm wrong, I only can see from the outside, but the reason why insurance is so attractive, even though people who are not educated can do well, is because a lot of it is about sales.
Yes.
And then the second thing is that the most profitable products tend to not be necessarily the best for people. I don't know if you agree with that.
Well, let me put it in more objective manner. Some people are good in building relationship, building trust, and sell the insurance policy.
Yes.
I do not belong to the category
really
who can please people instantly, who make a good impression instantly.
I see.
Or make friends easily. So for that matters, it may not be quite suitable for me.
I see.
So that's where, but my interest on financial management or investment does not stop. So that's where, as I study further, I think there's one point, I think there is some financial planner. There's one financial planner coming from Australia giving a talk to local community, talking about how financial planner in Australia do their business, deliver the service, and I'm totally overwhelmed.
Really?
Yes, I say I must go into this profession.
You were so impressed with how they did.
That's where I think one of the first financial planning course being offered called Chartered Financial Consultant course. Now I do not know whether it's still been offered or not. Okay?
Right.
Because now we are talking about more CIP and RIP.
RIP, yes, correct.
Okay. So I spent 2 years doing part-time to finish that course. So I started in 1998, and then I finished it about the year, I think about just before year 2000.
So it takes quite a while, right? 2 years to finish the exam about that.
Yes, part-time.
But I'm just curious, why did you decide to start with like will writing? With this? I know as a user, the benefit definitely of using a wheel writer instead of allowing the natural cost, right? They can execute a wheel, yes, for a fee, but it's very fast, right? But why did wheel writing interest you right after you decided to leave your corporate job?
I would say, number one, wheel writing is something new back then. 22 years ago.
Right.
That's number one. Number two, also to write will or to properly draft and plan a will, effectively, and customize to particular client, that require quite a lot of knowledge. Legal knowledge, and also estate administration knowledge.
I see.
So somehow that maybe satisfies my strong desire for knowledge and strong desire to apply the knowledge. So that's why somehow I feel very comfortable knowing about will, knowing about living trust, about testamentary trust and things like that. I still remember those days when I talked to the trustee people. It's like the lawyer inside the trustee company got chased by me to ask long list of questions until the moment they see me, they're like, not today. Not today.
Yeah.
Yes.
So, okay, I want to drill a bit deeper then now. So, I think one question is people ask, let's say in their 20s and 30s early, right? Do they need to start writing a will already? Or can they just wait until maybe they retire, then they start writing a will?
Yeah, I guess people may misunderstand to say that only people who got a lot of money, then only.
And it's very morbid subject also.
Yes,
it's linked to death, right? Yeah.
True. So like when you think about will, they think about you're planning to die or what? That's why you're writing a will. But that's not really true. That it's only working, or applicable to those people who got asset, because you could be young, but and then you maybe have very little asset, okay. But if you got dependents. For example, like your parents, or for example, some people who are newly married, they've got children. So I'm not so sure. I mean, maybe not a lot of people know that to appoint guardian For example, this young couple, they got one child. The effective way to appoint guardian, for in a situation whereby the husband and wife pass away, for their child is through the will document.
Right.
So that is one example of why young couple, with the child, need to write a will. Even both of them may have nothing at all.
I see. So I want you to explain in more detail, right?
Yes.
How should people go about writing a will? Because I do know a lot of people who say, I already write my will. But sometimes it's not written well, or maybe they entrust another executor, or they entrust, let's say, the bank to do it. But correct me if I'm wrong, I believe you're on the side that a professional will, like a rock willist, would be the best way of doing things, right?
Sure.
Maybe explain why that is the best form of executing a will rather than the other methods.
Of course, I do not mean to promote Rockville.
Of course.
Okay, but based on my professional assessment, Rockville is one of the company who have got long history in Malaysia. I think now they could have written more than 100,000 of will so far. So that really means something as far as experience is concerned. And will is a document whereby you do not just write it and then consider done. The will that we have written is meant to be executed, which means to say when someone die, the family member or the beneficiary will need to take the will document to the court, get a grant of probate, and execute it. And trustee, Rockville trustee at the point of time has got close relationship, I think with BHLB trustee in the beginning, and then eventually they started their own Rockville trustee. So with the experience of like drafting will and then executing will, that give them a kind of experience to pass the experience to the will writer as to how to draft the will in such a way that it is practical, and then is executable.
I see.
So it's not a theoretical will that you can write whatever you want, but come to execution, somehow the executor is very confused, the beneficiary is very unhappy. At the end, it leads to a law.
Of course, it can be very, very painful. So what are some of the common pitfalls, mistakes that people make when they will write, you would say?
I would say when people write a will, I think they may not fully understand the importance of executor. Because executor is someone who are considered your legal representative, upon your death. So this person will be recognized by the bank, will be recognized by the land office, recognized by the fund management company, that this particular executor represent the deceased. So he will receive all the money, and then he's basically has got his power to do whatever he wants with the money. Whether he invest it or whether he distribute or he would just want to delay and hold on to it. But some people do not know that. So when they appoint executor, either they just appoint their so-called best friends, which may no longer be best friend when they die, or may appoint one of the children, which eventually the particular child may not have the same idea or may have a strong intention to distribute the will according to the will to the other sibling. So that is quite tricky part. Another part is appointing guardian. That's also a pretty big issue. As to like who should be the guardian.
I see. For the children, typically, right?
Yes. Because the guardian is not the person who manage the money, but guardian is a person who take care of the children on the daily basis, sending him or her to school, to university, taking care of the medical of the person. So this part of it, some people also again may not appoint the right candidate for a guardian as well. Then also some people who are very wealthy have got their wealthy problem.
The headaches.
The headaches. Imagine, for example, you have got 50 million or 100 million and you're supposed to use a will to distribute your asset. Now, if you were to distribute your asset to your children, especially daughters, at a too young age. Because by Malaysian law, by the time the children reach 18 years old, they can receive the millions of yours that you distribute to her or him. The question is that, is he mature enough to manage this money, or will he be influenced by friends, or boyfriends, or maybe some con men, to squander away the money? So that's where the proper will for those people who have got this wealthy problem, maybe to stagger the distribution to their loving children, so that not all the wealth will be given to the child at one go.
Right.
Instead, it will be staggered, like for example, 10% at the age of 18, then after that 20, 25, 30, and even to the age of 50 years old. Okay.
Interesting. Okay. So I don't want to make this a podcast about will writing, not too much.
Yes.
But I just have one last question.
Yeah.
Is regarding maybe something a bit more specific, which is the liquidity. So if let's say a person's assets, wealthy or not, mostly consists of liquid assets, so unit trust, stocks, whatever. Typically, it's a lot easier, right? It's liquid. But I think it becomes more of a challenge when, and correct me if I'm wrong, it becomes more of a challenge when you have like physical assets, so like properties, right? If you, let's say this property, you split it into half to both your kids, you got two kids. One want to sell, the other one don't want to sell. How do you sort that kind of stuff? So what advice do you have to give to people where their will consists a lot more this kind of illiquid assets, and it can be properties, can be business interests, and things like that. Do you have any advice for those kind of people?
I totally agree with you. Malaysians like to invest in properties.
Yep.
And sometimes they like it too much. So there's a lot of properties been left behind, but with very little liquidity. I think what makes it matter most is that instead of giving one property, because since you have got so many property, then you should give one property to one child, 100%. So it's very easy for the particular child to decide whether I want to refinance a property, I want to sell the property, or I want to continue to stay in the property, because he will be owning the property 100% on his own. I think what is troublesome is to let the particular property to be shared among the siblings, and who eventually got married, got the in-laws coming in. So you can imagine got 3 children and 3 in-laws coming in, altogether 6 of them having different opinion and arguing whether they should sell, hold, or rent the property. So if some of this kind of issue that can be prevented when you have proper planning, somehow it may not be taken consideration.
Right. Okay. So I think we should move on into maybe a little bit more on some of the general principles or philosophy when it comes to money and investing. So there are many points of view out there, right? How will you describe the key tenets or pillars of how you look at money, and by extension, how you advise your clients?
I always advise the young people. I've been interviewed many times by many media as to what's my advice to young people. I would always say that in this world, there are 2 types of person eventually will become. Either you become a saver, you join the savers group, or you join a spenders group whereby you don't save at all. So I always encourage young people to force themselves to save.
I see.
Okay. And don't wait until that you got more income and you got significant bonus, then only you save, because that will just become an excuse. And you never save. So that's why I always suggest that even though you may be getting only 2,000 or 3,000 ringgit, okay, make it more hard, make it harder. Now you got only 2,000 ringgit after paying whatever expenses you got. Maybe you got very little left. But whatever little left you have got, even if you got 50 ringgit left, save that 50 ringgit. Because what you want to do is that you want to consciously and unconsciously squeeze yourself into the savers group.
Yes.
Why is it so important to go into this group? Because once you are conscious that you are a saver, you are the person who can save and you can continue to save, then you build a discipline. You build a habit.
A habit.
Okay. And then you know that you have the discipline to save, and that will eventually be the beginning of next. Then what do I do with this saving? Do I invest it? And the good things just will come along. Compared to if you do not get into this group, whether guilt will come in or not, okay, I always finish everything I have got. Sometimes I may spend more than what I have. I got credit card debt. Then the life is not so happy, not so positive, and then don't need to think about investing.
You let me know, see whether you agree or not. I think you are very right that it's about the habit.
Yes.
Even if it's 10 ringgit, right? Because as I'm sure you know, many people have different life circumstances. Like you cannot judge, say, wow, this one saved 10% of income, that one saved 30% of income. The 30% one is better. We cannot say that. Right? People have different dependents, different situations, whatever. But it's about that habit, like you say, that automated habit. The technical term I like to use is unconscious competence. So you unconsciously, you just keep doing it. So that when you do earn more money, hopefully in the future, then the habit remains.
Yes.
Right?
Yes.
And I like to ask you about this. So a lot of people say they cannot save money every month. And they say, but I will save my bonus. Right? I assume you recommend that regardless, you should always be saving some every month.
Yes.
And the bonus, as the name suggests, is a bonus.
Right? Save more then.
Yeah.
But you have a bonus.
Yeah. Yes. So you wouldn't recommend, like, because I know some people who are like, no, I all my savings bonus, and then I'll like take a portion of it and then spend it on holiday. Then the other half or the other 60%, whatever it is, I save as savings. That's not what you recommend.
That will not build a strong habit.
True.
So because I've seen enough excuses, given by people to say I just can't save.
Okay.
And some people who still just want to give me an excuse to say, I will say, yep, wait till I got higher income.
Okay.
Then I save. Then I give you an extreme example.
Okay.
We got a client who have got yearly income of more than $1 million. And cannot save. Okay. So don't tell me, now I'm earning 30,000. Wait till I got 50,000, then I save. No, I've seen situations whereby someone who earn $1 million still cannot save.
But what was stopping him from doing that? Well, I mean, $1 million is like, I mean, if I had income, I still don't know how to spend, That
also wow me.
Yeah.
That also give me a shock. Because that's why somehow people, when you get into the habit of spending and living in a modern world, in a materialistic world,
very easy.
It's easy to spend.
Yes.
People go and buy AirAsia ticket, and if you earn $1 million, you can choose to fly first class.
Yes. And
there's how many times more than the economy ticket that you can buy for AirAsia. People buy a shirt, that may cost me 100 ringgit. It's only got a good shirt, but you can buy branded shirt that can cost you maybe 5 times, 10 times more. So my experience just tell me there's no amount of money that's enough for you to splurge.
Yeah.
Right? You've seen also people who get into financial scandal, fraud, corruption, squandering country money.
Yeah, very familiar.
That's a lot of money.
Yeah.
But still not enough. So that's why, please don't tell me that you can save later. Show me you can save now.
Right. So one of the things that people might push back to what you say,
yes.
Is that as we grow older, we have lifestyle inflation. So what is very more nuanced about lifestyle inflation is that the people who make those points, I mean, because you won't look into their detailed financials unless they show you, right? Is that a big chunk of it is also something that they cannot control, which is inflation, something we are experiencing for the past year.
Understand.
Food, even those who take grab like I do. I know what the prices are now. And these are things that we cannot really control. And so how do you, as a financial advisor, advise your clients with regards to that sort of more uncontrollable type of lifestyle inflation?
I guess everything that we do in life, I think the best way to manage our finance is to give a end goal as to what we wish to have. So that's why a written holistic financial plan must be drafted before we talk about saving, investing, how to spend, blah, blah, blah. So because a holistic financial plan gives us a view, a vision as to what kind of life that I really want.
Yeah.
You know, and what are the financial goals that I have in my life that will make me happy, will take care of my family, you know, and will make my family happy. So with that big goals and big rock in mind, then only we figure out to say that, okay, then how do I go from there? Okay, so like what you say just now, it requires saving, it requires cutting down on spending, then that gives the motivation to do so. No, we if there's no financial plan, then we just say, okay, should we cut these expenses? Should we not cut these expenses? For what?
Yeah.
Then there's no context.
Yeah.
No, and it's become very hard. No, so that's why I always urge, you know, the Malaysian who are serious about growing your money, planning your money, then you should have a holistic financial plan done.
So when a new client meets you, right, is that the first question you ask? What is this for? Who is this for? Children's education, retirement.
No, and I mean, do you fancy to have a bigger house? No, and what do you intend to do when you retire?
I see.
So people got different inspirations, you know. So when all this inspiration was actually put into the paper, and they have got a personal connection to those goals, you know, that's where motivation comes.
Yeah.
So that's why financial plan is not about number crunching, not about how do we invest the money. It's about the ultimate question that we should ask.
What's the money for?
What's the money for? And what kind of life do we want?
Right.
Yeah.
So in your long years of experience and practice, right, what are the common goals that people typically want? And what's the weirdest one also? I'm just very curious.
I would say what's common for most people is to retire. To retire comfortably. Because I think gone are the days whereby you can raise your children, give him a good education, and expect him to take care of you when you're old. Okay? Confirm this is
of course, if you got
anymore.
that kind of son and daughter, fantastic lah. But
yes,
can't take that risk anymore.
Yeah, you can't take the risk. You can't hope. You need to plan for yourself. Okay? If they are really good, they are very filial to you, they'll take care of you, that is a bonus. Okay? So for that matter, when we do plan, so this is number one. But strangely, retirement is still not the most important financial goal.
Is it?
For Malaysian. For the married couple with children, we discover that children tertiary education, okay, whether it's a local university or whether it's an overseas university, always been placed a higher priority compared to the retirement. So which means to say when we do adjustment about how much you spend for your retirement, how much you spend for education, inevitably it will go to the point whereby
give and take.
This part of education, please don't cut.
Really?
Yes. No, don't move it. Don't reduce it. No, retirement can talk. I can retire 1 year later. I can retire 2 years later. I can live with less. No, but education, don't touch.
Right.
So much so it become a common best practice in Whitman that we ask, and I warn my advisor, don't simply go and cut our clients' children's tertiary education because you may make them very angry. Right. No? So even though you may feel that you have got a lot of reason to do so, don't do that because that is one of the most important things in their life.
That's very interesting to balance that the emotional part, right, of financial planning. And of course, rationally, we can see, look, I mean, the rational person will say, look, maybe during the baby boomer generation, right, they spend a little bit of money on their education because education is not as expensive last time. and you know, you get a nice 78% probability that your kid will, you know, come back and take care of you. Now, don't know what's that probability, less than 50%, let's call it, right? So if it's a less than 50% probability, the rational thing is, well, then why should I be investing so much in the kid? He or she can go and figure it out himself, what he wants to study and all that. And I have more for retirement.
Yes.
So when you go and talk to clients as nicely as you can and say that maybe they should reconsider this because of that whole risk of not, because the children is no more a safe investment. Let's put it that way. How will you approach that? Because it's a very, as you say, it's a very touchy thing, right?
That's why I say it's so touchy that we do not touch it.
Wow, don't even attempt.
So we will talk about maybe you should, let's say, retire 1 year later, 2 years later. Maybe you should cut down your retirement expenses. Maybe you should increase your saving now. Maybe you should increase the return of some of your investment now. So they're prepared.
They're prepared.
They're open to do that. But don't touch the fund they intend to give to the children.
And in your experience, none of your clients come to you and say, you know what? I'm going to cut the education. I'm going to increase my retirement. Never.
Not that I know of.
Wow. Okay. So speaking of retirement, right? I guess one big question or one big goal, I would say, a lot of people want when it comes to retirement is to maintain a lifestyle.
Sure.
Right? That's one big one.
Yeah. Or enhance a lifestyle.
Or even enhance, right? Because hey, now I can cash in on all my years of hard work.
Yes.
My dad is actually retiring at the end of this year.
Yes.
So there's talks of renovation. There's talk of holidays, exactly.
Playing more golf.
Yeah, exactly. So how do you usually tell people, and of course there's a lot of variables, like when is this person asking the question, but what are your top advice for people who want to not just retire, but retire with the same lifestyle and higher or even an increased lifestyle?
See, I think what's important is that as a financial planner,
yes,
we must not judge a person.
Yeah,
we must not have certain judgment to think that, okay, I think you should cut your expenses, you should do that, because everybody is different. Some people who has got such a good or high standard of retirement lifestyle in mind, they may have a lot of wealth.
Yeah.
So that's why we will not comment, say anything. We just hear out the client and then just put away numbers that we got, his asset, whatever he want, into a holistic financial plan. Then from the plan itself, then we only will be able to tell whether he has got enough to last him up to the age of like 85 or 90 years old. Okay, for the kind of lifestyle that he want to have. So if he can afford that, by all means, go for it. But if he does not have the kind of money, if he were to spend the kind of money to maintain the kind of enhanced lifestyle, the money, he may retire at 55 and the money may finish by 65, then it's going to be like alarm to him. No, don't do that. So we need to relook at the plan.
I see. So of the levers you can plan, right? Usually which are the easy ones? So I can imagine, for example, maybe I don't know, increasing investment returns, saving more.
You are quite right. You are quite right. For most Malaysians, somehow, despite the time and the effort they put into investment, but sad to say, a lot of time the investment effort do not seem to generate the kind of result they deserve.
And the reason? Reasons?
The big reason is because that I think there is the inclination to take higher risk than what the person is supposed to take.
Yes. I remember you wrote an article, right? Does higher risk equal to higher return? So maybe you want to share a little bit about that kind of mindset.
I'm going to the forte of yours, which is share investing.
Okay.
I think that there are people who do not really understand the nature and the risk exposure when it comes to investing a single stock.
Correct.
If you remember in the year 2020, when there's a beginning of pandemic, then this rubber glove stock has been like shooting, through the roof.
Yes.
And it attracted many retail investors who never invest in share before, just go and chase the stock. So that's why they're thinking that, well, this is the stock that cannot be wrong, and they can buy, chase, put more money into it, and it continues to go up and go and go up. But they forget to understand that whatever go up, must come to the point whereby the valuation is just too ridiculous. There's no such thing as ridiculous about the pricing. There's no such thing about more supplier will come in to set up factory to produce it, then pressing the price, the order of the existing players. No such thinking, and that's where it collapsed.
I see.
And I have got personally my clients or a few clients who have lost 60, 70, 80% of the capital investing in rubber glove stock.
Easily.
So this is what I mean, that in the first place, why do you go and chase the return of a share investment? Okay, and the fact that you don't really do research, you don't even know what's a PE of it, and you also do not know what's the management or what's the industry whereby they are operating in. So for that matter, this is one vivid and very dramatic example as to how Malaysian, do not have a proper plan, do not have a proper strategy. Just jump into a high risk investment and then lost 60% or 70% of their hard-earned money. And imagine how damaging it is. That cost the person. Imagine the person have got, say, 500,000 saved over maybe 5 or 10 years, wanting to plan to achieve financial freedom. Sekali now, 400,000 is gone and it's left 100,000. And the whole financial plan will just go derail because of that single decision. And this is only one example. And there are plenty more in the market, and you should know.
And bigger figures than that.
Bigger figures, different type of investment. And it never ends. You have Geneva Gold, come and gone. Then you have got money gains, JJPTR, come, gone. And as well as the new one, I don't want to name the names.
Sure. So one of the reasons I realized that people fall into this trap, and even for myself also, I also fall into this trap with, luckily I'm smart enough to diversify. But if I put everything inside also, that will be the same scenario. What do you say, how do you help your clients prevent that, essentially, for lack of better, envy? Because a lot of the reasons why they don't do any research at all and things like that, before they go into investment, because they see their neighbor doing it. That especially if their assessment is the neighbor not as smart as them, or they're also doing this, of course I can do that, because the neighbor, right?
Because the not so smart neighbor have just make 100,000.
I can make 200
I can make. I cannot be more stupid than him.
Exactly. And also, one thing that people don't practice when it comes to liquid assets is that if you ask them to buy a property, they're very hardworking. They go see the different house here, price there, So they sound very rational. But with liquid assets, not so rational. What will you tell, not even just your clients or friends and family members, right, to not succumb to the kind of comparison,
I would have to disagree with you, because some people are just attracted to properties. Okay, so they are not rational about property investment as well.
Oh, really?
Okay. They can go very crazy about property investment. Okay. And there are some people who just fancy share investing.
Yes.
And then also you cannot stop them from buying more share as well. So they are crazy about share investing. So this is the build up, the psychology, mental build up of different investors.
That's true.
So the question now is that what you're saying just now, how do
you help people control the urge to always compare? Like I said, the example of the neighbor, things like that.
Yeah, you may see me like, talking like old broken record like that, just repeating what I say. But what I found to be effective is to ask the person what he really wants out of his life. It is very important to have a big picture in our mind.
Yes.
Before you go to the detail as to should you invest in stock, or should you chase that stock, or should you buy this or buy that. Let's get a big picture in place, because what is most important, other than religion, is about this life.
Yeah.
And this life need money. And this life need you to plan your money well.
Yes.
So once you're very clear about where you're heading and where do you stand now, and we have given you very clear guideline that you should get this kind of return and you should get this kind of saving every month and things like that, then there is a framework for you to follow. There's a guideline for you to decide to say, well, that is my neighbor's decision. That's what my neighbor is doing. But maybe he got no financial plan. That's why he's simply, trying to chase the return. But I am different. I got a plan. I know clearly that I do not need the kind of return, and I'm on track. I just need to behave. Then I'm fine. So that's how it goes.
I see. That's very true. That's very good advice. It's also something that I've learned definitely in the past 1 year or 2 years as well. As you know, because markets are very volatile, right?
Sure.
Okay, so specifically to how you usually advise people to asset allocate, right, for their investments. And I know in your book, you're a fan of the proper kind of diversification.
Sure.
Right? So obviously, when we talk about diversification, capital allocation, I mean, to allocate capital, it is assumed you have capital, right? So this is more for advice of people who already have assets. How do you give your advice on how much should be in, like, let's say, unit trust, how much should be in stocks, how much should be in property, or any other type of investments?
In the first place, I think let me go to something basic. I think also the gist of the new book that I have got, the Financial Freedom Investing.
Yes.
The reason why I share the ideas about how to investing in the book is because it all come from my experience.
Yep.
Like what you say just now, that people tend to get attracted to high return, promise kind of investment. It could be high risk, but they don't care. And they could be trapped one time, they could be trapped second time, they don't care.
Yeah.
That's where I look at the client that we have got, and those clients who follow our advice diligently, how come they don't have this problem?
Yep.
So when I have got this comparison, then I decided, it's because once we have a financial plan, we help them to decide based on the plan what kind of return they need to achieve.
Yeah.
And guess what? Most of our clients, I think, if not all our clients, only need to achieve single-digit return.
Yeah, true.
And they'll be able to beat inflation. They'll be able to compound their wealth and their saving to achieve whatever they need to achieve for their financial plan.
Yeah.
So for that matter, Whitman, despite of the many years of us advising the client to invest or helping them to invest the money, we never need to look for some investment that can give 20% return, 50% return, or even 100% return. We never look beyond that. Any investment return or proposal the client gives to us that promise 16%, 20%, knowing that high return will expose the client to the high risk, we just shoot it down. So for that, that's where I find the urge to say that maybe a lot of people out there, who do not have financial plan or do not become our client yet, they do not know such a reality.
Yeah.
So that's why in the book I mentioned that for most middle class Malaysians who are educated or tertiary educated, you only need high single digit return, and you'll be able to achieve your financial freedom and your plan and take care of your children's tertiary education. So then the question now is that how do you build a discipline to make sure that you'll be able to achieve this return?
Yes.
No? So that's where I develop a lot what we've been using internally. We call it SRB standard. No? Something that number one, it got to be safe. Number two, it got to be investment that will always rise in the long term. And number three, it got to be investment which is best of breed in nature. No? So when we introduce something like this, then we'll be able to help an investor to focus as to and to accept the fact that I can live with my life or my investing journey, aiming for single-digit return only. No? And that's where I see many of our clients, they're
very
happy
possible.
with that.
Very possible.
Yeah. No, whereby you can see some of the counterpart who are in industry, unit trust consultant or bankers, they face a different problem. No? I always have got the proposal received from some of my clients, actually most of our clients, this proposal for the bank, proposal for the unit trust consultant. And look at the fund they propose. It's not diversified. It's so risky. No, technology fund, China fund, whack 500,000 into one fund. I said, this is risky. No? And do you know, and when I get to know that agent, when the client introduces things like that, I say, why are you doing that? You see, this agent has got a totally different worldview compared to us. Because in his world, he say that if I do not propose something that really, exciting, give the thrill, and really increase the heartbeat of the client will just fall and sleep and ignore his proposal. Can you see the contrast of worldview that we have got?
Yeah.
And that's why people like that, without a financial plan for the client, have got no choice, but always need to up the risk, the return promise to the client out there, and it becomes a vicious cycle.
Yeah.
And client who ask for higher return, client do not know the danger or the whole picture, ask for the high return, then they get what they want, then they lost more money. And then the unit trust consultant who do not know that the client actually do not need that, continue to pursue, to look for fund that can give higher return and expose the client to higher risk.
Right.
So it is quite sad.
Yeah, indeed. And so let's talk about that single-digit return or high single-digit return. 8-9%, let's say a year, it's very good for a lot of people already. Now in Malaysia, we have I would say we are very fortunate that we have EPF, right? That gives us essentially 5-6%. And then you can start withdrawing at age 50, I believe. To go from the 6 to 9%, right? Doesn't seem like a lot on the outside. But you and I know that work needs to be done for that.
Yes.
So, of course, as an advisor, you cannot be saying, or I wouldn't say you cannot, like, it's a harder sell to say, just aim for 5-6%. Then clients might say, well, if you're advising me that, then why do I hire you? I can just put it in EPF.
Sure.
So how do you construct something for a client that goes from the 6 to the 9%? Of course, we're not talking about the 15 and 20, just the 9%.
Most of the clients that we are dealing with, EPF is only part of the liquid asset they have got.
I see.
So, of course, for the EPF part, to beat inflation effectively and to compound the return, it's important for us to move from 6% to 9% or at least 8%. Okay. But for the liquid asset like cash, then the bank interest is giving about 2%. Or maybe 3%. Okay. Then to go to 8%, that is still quite distant to go. Okay. So that's our job to look at it holistically and suggest them how to get the return. So for cash part, we always diversify the portfolio. Okay, we believe that based on the study, most of the equity market, even though you are like diversified across the world, you should be able to get something between 6 to 7% or 8%, depending on which time period.
Yes.
Even if you just diversified it without picking any particular stock.
Yeah.
So that leave a good foundation for the client to grow their wealth. So that's why I say, they got to diversify their investment, so they'll be able to grow steadily over the long term. Okay, but along the process, of course, we want to make sure the vehicle is safe, and at the same time, we want to make sure that we get to choose the best of breed fund. So, for example, if we are aiming for, say, a China fund, we want to choose the better breed of the China fund compared to any ordinary China fund, something like that.
Right. So what's a typical process like when you go through your clients and choosing a fund? If I want higher return, what do you recommend? If I'm okay with just 7%, what do you usually recommend?
In the first place, maybe I should actually highlight to you another thing as well. When it comes to financial, this one you talk about, how do we convince a client who has got now 6% from EPF to invest the money to go for maybe 8% or 9%?
Yep.
That also seems to be a lot of money.
Yes.
So what's the motivation? But I think the point is that a lot of people underestimate what the 1% and 2% will make
over time. Yes.
Over 30 years and 50 years from their life. For someone who are like 30 years old or 40 years old, he has got another 40 years before he died. And he got to manage his money and continue to compound his money for next 40 years.
Yeah.
So you may look at like extra 1% difference, but that would make a significant effect that you cannot imagine using your simple arithmetic. You got to put into the
geometric
software,
they call it
or geometric, then you can see the picture. That's number one. So we are being privileged because we always talk to the client using a holistic financial plan. So the client can see, whoa, you do 2% extra, that make a lot of difference. So then they are motivated.
Yes.
Okay. But the question is that, again, it's not as simple as that. How to do that? So that's where we come in to help the client to get the return.
I see. So, I mean, the vehicle, especially for the liquid asset sides of you helping your clients, typically is through unit trust, right? The big criticism of unit trust today is the sales charge. You've got places like the US where essentially ETFs has completely almost destroyed I wouldn't say destroy but they have severely put the unit trust in the history books, right?
Stone Age.
But Malaysia, we are still in the Stone Age in a way. Charge 5%. That means, right? I mean, if people know the math, right? If you are 5% down, right at the beginning, and actually if you add in the management expense ratios, that's what, 6% maybe? You have to grow by 10-12% to go back to your original capital already, right? And a typical unit trust don't make 10 to 12% a year. So you probably need to wait at least 2 years or 3 years to get back your capital from the sales charge and all that. Is this something that you'd like to see change in terms of the sheer amount that when it comes to the sales charge?
Okay. Well, in the first place, Whitman do not only recommend unit trust when we actually ask the client to grow their money. We also recommend them to buy into properties. We also recommend them to buy into ETF, the latest innovation. And we also ask them to get into robo-advisor for certain asset class. So being an independent advisor, we need to be very open as to what is the latest option available to help the client to grow the money more effectively.
Yes.
That's one. But say, what do you say just now about unit trust? It is true. Whatever we say about unit trust here, somehow it is the one of the most common liquid investment in Malaysia.
Yes.
So like it or not, when we see a client, the client will have 500,000, 1 million of unit trust at hand. So we just have to figure out how do we improve it? How do we overhaul it to a better one? I totally agree with you that the traditional unit trust way of doing business is really unfair to an investor and is not doing good service to help the client to achieve financial freedom.
Yeah.
That's why Whitman, when we operate our unit trust advisory to the client, we are using an online unit trust platform which has access to
you can buy
almost
directly,
all the company, almost all the companies in Malaysia. And as an advisor, we also have a discretion not to charge the client 5%. So in Whitman, most of the time, the effective sales charge that we charge to the client is only 2%. So we are totally aware that if we charge the client 5%, then the client may not break even in 1 year. Chances are he may take 2 years to break even. And to me, that is so unfair to the client.
Absolutely.
So that's why in Whitman, generally, we are charging about 2% for the client to enter in unit trust. But as I drill into this area also, I also find something pretty sad in the sense that most unit trust agents in Malaysia do not get proper training and support to really do a good job for their investor. What do I mean by that? Number one, when it comes to unit trust fund, one Malaysia equity fund is different from another Malaysia equity fund. Okay, so but traditionally, unit trust agent, they are tied to one particular fund house. Okay, whether the Malaysia equity fund is good, bad, average, or lousy, they just got to take the Malaysia equity fund and sell it to their friends.
Yeah.
And their friend end up to be the victim of holding a lousy Malaysia equity fund. The fact that his friend came to that UTMC.
Yeah.
And that's it. So, but on the online unit trust platform, advisor like us, who have got the QTA license, corporate unit trust advisor license, we get to choose the best Malaysia equity fund among the 30 old companies. And come to the global equity fund, we get to choose the best global equity fund among the 32 companies. So that helps the client to increase the chances to get a better return, to avoid lousy funds. That's one. But that requires extra skill. That requires extra work. That requires a proper platform, which traditional unit trust agents do not have access to.
Yeah.
And investor or unit trust agent just a lot of times still thinking that my job of selling unit trust is to sell unit trust. You see, company launch a Japan equity fund, I sell Japan equity fund. My job is to sell, and my job ends after I sold, and I earn the 5% commission.
Yep.
That's it. But that is not really getting the client anywhere, because the client who entrusts you to buy unit trust from you expect you to advise him what to do next. When the fund make money, perform, what should I do? When the market go down like now, 30%, the client also expect you to advise what to do. Unfortunately, traditional unit trust agents are not trained at all what to do. So that's why in Whitman, being a financial planning company, that is not in our blood. Our blood is to figure out, okay, people complain about unit trust. No, but the question is that we need to study to see what is lacking.
Yeah.
What have not been done. And step by step, one piece by piece, we put in whatever necessary measures and the strategy to be in place to help the client and to hold the client hand when the market continues to go up. Start taking some profit. So then you got some profit at the very safe investment like money market fund or bond fund.
Okay.
And whatever go up will certainly come down. And when market come down like this, 20% drop, 35% drop, take the money, and invest it back. And repeat the cycle. There's always a cycle. So that's why, since you're asking me, I like to call what we actually do is what we call premium unit trust service.
Wow.
Yeah, which means to say, you're not here to sell. No, you're here to service the client. And you are here to service the client to make sure the client can really get the value of the fund and get to make the right decision when market is up and down. And 5 years, 10 years down the road, the client get enough fund, profit to support his financial goals.
I think this is a great segue into the discussion about the industry that you're in, which is the financial planning, insurance, unit trust agent kind of industry, right?
Sure.
And I just know a little bit because I have friends in the industry as well.
Yeah.
The difference between a fee-based and a commission-based agent or advisor, whatever word you want to use. And I suspect that the reason you are so passionate, right, about this way, a more needs-based is hand-holding the clients, things like that, premium service, is because you are by and large compensated through the fees that they pay you, right? It's a fee-based.
Sure.
They are paying you. So they are your paymasters, and so their interest is the most important.
Sure.
Whereas if it's a commission-based, yes, of course, you as the client that buys the unit trust, you don't pay any money, let's say monthly or every year.
Yes.
But you pay in two ways. One, of course, the fees, the commission, and also the potential bad advice they're gonna get, right?
Yes, true.
So,
yes.
but you see, that's the I'm talking about the industry dynamics now, where a bank, we don't need to name names, but we know that the three big banks that are in the unit trust that dominate 60-70% of the assets under management.
Sure.
They will always want to stick to whatever it is now because A, is so profitable.
It's money machine.
It's so profitable, right? And for virtually very little work, because the sales agent is the one that's doing all the hard work.
Yes.
They are just the ones with the license to distribute the funds and all that. And so you got that machinery. Then when they come to someone like you and fees-based, then they say, oh, I have to pay you every month or every year. Wow. Then they're expecting some sort of return, especially immediately. And I do know definitely the traction for what you guys are doing is a lot lower than the commission guys, right? Because they're using greed to drive the industry.
Yes.
But for your specific part of the industry, it is driven by nobler intentions. How do you get people to trust you instead of the agents and all these people who are pushing all these products versus service?
Maybe I should update you a little bit of background.
Yes, sure.
When you talk about traction, I must agree with you. In Malaysia, we are privileged, to have enough clients to pay up for us for financial planning fee, get a full financial planning service from us. That's good enough to keep us to be a profitable company and to also make me financially free. Okay, but somehow I'm a funny guy. I'm not fully satisfied by having money. I just want to make a difference.
Yes.
Just like when I was young.
Yes, exactly.
I'm here to change things for better.
Right.
So when I discovered that, how come there's only that many people who's willing to pay fee for financial planning, then I know that is a bottleneck for my business. So I started a new division. And this new division, I will recruit advisor who's willing to come to our apprenticeship program to learn how to deliver premium unit trust service without getting the client to pay financial planning fee. So this is a service whereby the client will pay a sales charge using a wrap account, they call it, for under online unit trust platform, and pay some form of advisory fee as far as the unit trust management is concerned. Okay, so that service has been something that we've been doing for the past 2 years. And I mean, to be fair, we have got advantage of doing advisory for clients for the past 20 years. So we take whatever that we have learned as to how to advise the client to make the right decision, how to coach them and incorporate into this premium unit trust service package. So that's where now we are having more and more advisors who want to upgrade themselves, joining this apprenticeship program to learn how to add the extra missing point, missing picture in the whole unit trust advisory to help the client to get the kind of high single digit return, and help the client to be very peaceful with the investment, whether it's a bull market or whether it's a bear market.
Right. Makes sense. So, but when you talk about this program, apprenticeship, all that, right? What are you looking for in young wannabe advisors, right? What are some of the core things that they should have? Of course, everybody brings something different to the table. But what are, like, if someone wants to be an advisor for Whitman, what are the must-haves?
You see, what I discovered when we started to talk to this assisting unit trust agent or assisting insurance agent or CFP graduates who somehow already in this industry. And then I started to understand the kind of challenges they face. And I'm glad to find that Malaysians are generally quite nice people.
Oh yeah, that's true.
With good intention, wanting to do something that add value to friends and clients. But however, they are limited by the knowledge they have got, by the support, by the training given to them. So what we intend to do under this apprenticeship program, you ask me what kind of quality they have got. I must say that there are easily about 100,000 unit trust agents out there. I would say not every one of them is suitable to come to this program because like what you say, some people will just want to make money faster. And some people find that doing the unit trust sales currently is more profitable than being professional.
Yes.
So that's why I believe, and
in fact, if I'm not saying, it's even more profitable than, insurance is more profitable than unit trust right now. I believe selling insurance.
I mean, if you look at like single case.
Yeah, sure.
Basis,
okay, right. Okay, sorry for interrupting.
Sure.
Continue.
Yeah. So for that matter, what we hope to attract, is those unit trust agents or insurance agents who want to upgrade themselves. Okay, who are not happy with whatever they can offer to the clients. Yeah. Because I know quite a number of them are very frustrated as well. They mean well, they want to add value to the client, but they just don't know how. At the end, they go into a vicious cycle whereby the client continue to lose money. The client is unhappy, but they also are going through tremendous stress. So it becomes something that they don't really like. So that's why I believe that those who want to take care of the client, take care of their friends, who want to upgrade themselves professionally, who want to get satisfaction from doing this business, and not like what you say just now, unit trust, that don't seem to be the sexiest financial product to offer, and change that impression. Welcome to the apprenticeship program.
Awesome. Okay, so we talked a little bit about industry. I think this is the last part. We want to talk a bit about your book, and I want to give people a teaser of what they can expect in the book.
Okay, sure.
So I listed down a few things here that I found that was very interesting to me.
Sure.
So the first one is actually you have a segment called taking blame for investments. Who should be blamed whenever an investment goes bad? And my view has always been the investor, because you are the one that put in the money, and even you can say X so and so misled you. You were misled, right? And it's the same with. I will always remember. I'm not sure if we are familiar with the high flux situation in Singapore. Right?
Yes.
A lot of people bought the bonds because it's guaranteed. But then after 10 years of mismanagement, the company went down. And so they started blaming the Singaporean government. Why you never catch high flux? And then they blame high flux, saying, why you never release information that was that is relevant for us to know that you have all these risks. And to be fair, a lot of them were retirees, and there was a whole demonstration.
Protest.
Yes, a protest. When I look at that, yes, I pity the old man who was up there complaining because, of course, it's always difficult. But who do you think should take the blame when an investment goes bad?
If we were to look at the incident in a very objective manner, of course, investor who have got the decision to make, whether to invest or not to invest, they got to shoulder the responsibility.
Yes.
But I mean, maybe that's my answer when I was much younger.
I see.
But having gone through this industry for the past 20 over years, I see life not so simple as that.
Sure.
And with the ever-changing landscape of more products, nowadays more and more banking products that used to
very
be
confusing,
available to only high net worth clients now become retail, and getting into like mini size and go to average investors. This is all what you call
derivative products, all that.
Yes, this is what you so-called democratization of the financial products. But then imagine that average investor, whether it's retiree or working person on one end, this particular person do not have much knowledge.
Yeah.
To update all these latest products. And number two, the person also got very limited time. So that's why maybe I'm quite known that you say in the beginning that I'm one of maybe a figure person who have spent a lot of time writing articles, writing books, going to radios and TV, trying to do education. In fact, I never really believed that the kind of education can really effectively help an investor. Simply maybe from the fact that I just know how vulnerable an investor can be under the influence of financial institutions, agents, friends, neighbors, advertisement, and things like that. So if you ask me what is the most effective way to really protect an investor so that they don't have to be so guilty, for making one decision, is to find a trusted advisor who's competent, knowledgeable, and selfless and professional. To be able to sit by this person, to go through every stage of his life, to look through every proposal come his way, analyze it for him, what risk this proposal may bring him to, and then reflect and go back to review the financial plan that he's got and make every decision. And when there is a bear market right now, ask him to do the right thing and not to do the stupid things, by somehow like chasing return and whatever things like that. Exactly. So if you ask me, I believe that having a trusted advisor who's professional, is the most effective way. So that's why you see now, I'm not happy with just running a profitable, respectable boutique advisory firm of 20 old advisors. I started 2 years ago the apprenticeship program, intending to reach out to more advisors. Because I believe that there are many Malaysians that I will not be able to get to know for the rest of my life. But by having access to this advisor who have their own network of friends and clientele, we will be able to pass this positive system to more Malaysians. So that is maybe my newly discovered way to change the industry.
And to your point about all these options on democratization, right? I think two things in your book, I'll join them into one is that actually that if someone has more choice, there's more risk. That's very interesting because there's a bit of a choice worship, right? People want more choices, right?
Yes.
And will you agree with me that really it's actually like more choices actually paralyze you?
Yeah, true.
Right?
True.
And you actually cannot decide. But then people are telling you, yo, you got to decide, inflation is taking up your money, or you don't invest, and things like that.
Yes.
And that also links into my next point, which is like uncertainty. Because imagine we know the world is really uncertain, and then now we got so many choices to try and manage that uncertainty. So usually when people are afraid, let's say, let's use the other spectrum, right? Just now we talked about the dangers of high return and all that. How about the dangers of being so paralyzed by uncertainty? How do you help people through like, market very bad, very scared, volatile, right? Equity markets are always volatile, very scared, right? Property, got this problem, that problem with managing tenants, or that very, very difficult. You always get clients like that, right? That don't want to do anything.
Yes.
How do you get clients like that to take a bit more risk in that sense?
Yeah. I guess number one, okay, we must start with holistic financial way to motivate them.
Yes, of course. Their goals, objectives,
okay,
right?
That's one. Next, we got to be experienced enough to understand what fear do they have. They're stopping them from taking action. No? Is it because they are afraid that they'll lose money? Okay? Or is it that they're worried that whatever they buy will go down further? They'll lose even more money? Okay? Or what? So somehow this is the part whereby you need to play the role of psychologists.
Yeah.
To really ask questions, try to identify what is the real fear. Okay? And once we identify the fear, okay, we can use whatever information, whatever knowledge and experience that we have got to share with them. To share with them to say that if you think that putting money is safe, okay, investing in the market right now is not safe. Let me share with you more to show you what you know is wrong. Because I can show you that putting money in the bank is not safe, and investing money in equity market with the right way, with my support, is safer. So the client inevitably will get the kind of aha moment and say, how come I never thought about my finance like that? No. And I think what you say makes sense. And let's start doing something.
Okay.
So it requires a lot of human skill.
That's
understanding,
true.
What is like, you say just now the word, paralyze them, and start moving them.
Yeah.
And one thing about this part about robo-advisor and human advisor, I always feel very proud, always feel very privileged, and feel very advantaged being a human.
Yeah.
Because when two humans sitting next to each other, talking about dreams, talking about fear, talking about what decision to make, the client can always feel the warmth. Can always feel the kind of the sincerity, and the integrity of another person. To really want to hold him to get out of whatever situation that he have and to go to a better place. But imagine if I'm a robot, how is it possible?
Yeah.
So that's why I come to the stage of my life into this practicing. I think I also can't really describe what are all the factors needed to be in place that really help the client to eventually make a better decision. It becomes something like gut feeling. It becomes like instinct already, But
all your years of practice, right?
Yes, it's an instinct.
It's so ironic because the whole objective of robos advisors forming is so that they can take out the human element.
Yes.
But what you're saying is your experience is that if there is no human element, that might actually be even worse.
Even worse.
Yes, but of course you need the right human, of course.
Yes.
Right.
True.
That's the challenge. Okay, we are coming towards the end. I only have two more things that I really want to talk about. And this next part is probably I think when I read through a book, probably the one that caught my eye the most. And that
I want to know that.
yes, and that is Mr. Robert Kiyosaki.
Okay.
And you mentioned that you had a snippet, I remember reading a book saying that his advice can be dangerous. Now, of course, the context is that Robert Kiyosaki is everyone's, in a way, first love. Their first love.
First love.
Their
Okay.
first love.
Okay, I like that.
The book is their first love, right? Maybe your book will be their second love.
Hopefully.
And people worship him, right? There's always that famous investor quadrant, right? Employee, business owner, self-employed investor, be an investor or be a business owner, something like that, right?
Yes.
But you seem to think that part of some of his advice can be quite dangerous.
Yes.
And that I mentioned I remember you mentioned in the book that people go through the Robert Kiyosaki course and then straight away they leverage their properties to the hilt and
then start a business.
Start a business.
Left the job.
Yes, start the job. So maybe explain in more detail why you think that Robert Kiyosaki can be dangerous. The advice.
I believe that, of course, when we read Robert Kiyosaki book, we feel very excited. No, there's a lot of adrenaline. Okay, but if you were to think deeper, maybe my job give me a lot of opportunity to think deeper about the kind of advice and compare to what I read from him. He's advocating that everybody can be super rich, as long as you can be aggressive and you can take risks. No, if you can take away the kind of employee mentality,
yes,
and then take in the business owner mentality. But somehow I believe that this approach, the direction, the end goal, I agree. We want to be richer. No, we want to be more financially comfortable. I totally agree.
Yeah.
But what I do not agree is the approach. I would think that his approach is too aggressive.
Yeah.
No, to me, if we were to take a two-step approach, okay, that will be something more pragmatic. What do I mean by two-step approach? First step is to make sure that you have a financial plan, build your wealth, grow your saving, in a way that you can achieve financial freedom. No, maybe not the kind of very fancy kind of financial freedom, but a basic way of financial freedom. Then you know that you have got the capability to come to this stage already. So you have achieved financial freedom. Then next, only since you're well trained already, in a way, you become more financial savvy already. You know risk better already because you have come this stage already. Okay, then only you take the next jump. You say, I want to become rich. I want to actually go into properties. I want to go in the big way. I want to share market and things in a big way. But at least you have prepared yourself, better already. Or you may discover that once you reach the financial freedom, suddenly you find, hey, I'm quite happy being where I am now. No, why should I take so much risk? No, or such
why spend more energy? Why?
Yes.
Yeah, I want to do other things.
Because life, has got other things.
So many other things to do. Yeah.
Yeah. No, and I find that being financially free is good enough. So that is, I think, what I advocated in the article.
Yes.
And I believe that it is more practical for most Malaysians.
You know what? One thing I'm not sure if you are aware that most people are not aware with Robert Kiyosaki is that he got bankrupted 2 times before. And what got him out essentially was actually selling all his books. So his wealth was not generated by the risk-taking behavior that he describes. It was like the foundation was all his books and his talks and all that, which if you think about it is pretty low risk, right? You're just talking and writing, right? And another thing is with the property one, this is something he also, I think, I don't say irresponsible, certainly could be emphasized more. When he talked about the leveraging of the properties, right?
Yeah.
He tend to not tell people that he actually parked these properties, right, in a LLC, which then shields the liability from his personal assets.
Okay.
So anything bad happens to the venture, right?
The LLC.
The LLC. only the LLC dies, he's safe. But people don't know this difference.
Yes.
So they go out and then they put it in their name.
Yes.
So bankruptcy risk happens to them.
Yes. So that's why I put an analogy at the end of my article is that what Robert Kiyosaki asking you to do is like asking you
F1.
to drive F1 car.
Yes, I remember.
It's not easy to drive an F1 car, you know? No, at least you have to go through a lot of training, first. Then only you feel more confident and you can control the F1 car.
Yeah.
Otherwise, I think unfortunately I see some friends, some people that I know blindly follow Robert Kiyosaki advice. At the end, I don't know whether they become bankrupt, but definitely they face a lot of financial challenges along the way. Yeah.
Very, very true. Okay, just the last bit. Let's circle back all the way into the beginning, right? Which is the story about your dad and how a businessman can mismanage finances. It's not easy. And also in your book, you mentioned that it came as a surprise to you how a lot of people who are very good who are F1 drivers, who can drive the F1 car, right? Who build successful businesses are actually really, really poor at managing their finances. A, why is that the case? And B, what advice do you have out there for business people specifically now that have that kind of liquidity to manage their money?
Let's put it this way. Businessmen and successful businessmen require a lot of guts, a lot of foresight, and also willing to take a lot of risk in order to be successful in the business they have got. Okay, and that's not only that. When you want to succeed in the industry, you need to go for a niche market, and you must concentrate all your resources, money, attention, and effort into that niche industry. Just like, for example, Microsoft, they focus on the software only. They do not do the SIM card. No, they do not do the memory card.
Computers.
They do not do the hardware. They do not do phone in the beginning. So they just need to be very focused in writing the software, to be very successful. So this is how businessmen succeed in their business.
Yes.
But then what you're saying just now, then what happened to the money they make? Okay. Now, if they carry the same attitude, same character to manage their hard-earned money, okay, then the risk is super high. Okay, because to manage his money, to preserve the money that he make, it requires a totally different cycle, psychology or mental set. What do I mean by that? Say, for example, when you want to manage and preserve money, you got to be very risk conscious. You must figure out how to avoid the risk and not taking the risk. Okay. So, and at the same time also, when you want to avoid risk and minimize risk, you need to diversify your investment. You are not supposed to concentrate your investment into one stock or maybe
like how a Microsoft would lah. Yeah.
Yes. No. So you need to diversify it. So as you can see now, creating money requires one set of personality. To preserve the money and to grow money steadily require another kind of personality. So in that case, unless the businessman can be so versatile
yes.
to switch his mind, neutralize his strength to become another strength, to develop another strength, then the chances of him managing his money well is a big question mark.
Yeah.
So that's why, again, the most effective way is not to neutralize his strength, not to change his personality, but for him to continue to do what he can do best. But to appoint a financial advisor who's professionally trained to be risk averse, to be good in managing risk, and to be very good at diversifying the wealth into different parts of the world and different kind of asset class. And for that matter, with a small fee compared to whatever wealth that he has got, this business owner can get to continue to do what he's doing best, and he can also get to have the peace of mind that his wealth is well protected, well preserved, and continue to grow. So somehow, I like to think that is an ideal solution for a business owner.
That makes a lot of sense, right? Because getting people to change is always very, very difficult. Right.
I also doubt whether I can change myself now.
Yeah. So, I mean, just to sign off, right? So I have the book here, and how can people get this book?
This book is now available at all the major bookstore, MBH, Borders, Populous. No, I believe it's all available. No, you can go to the bookstore and get the copies.
And what I like about the book is that it's actually a collection of your articles, so it's very topical based, right? It looks the book is very thick. You might be intimidated, but it's actually all like very bite-sized information, right? 3-4 pages of a specific topic, and then done. That's what I liked about the book. So yeah, Mr. Yap, thank you so much for being on the podcast. I hope you enjoyed your first experience in this sort of setting.
Thank you.
Yeah.
Thank you. This is the first time also I get to share my experience.
Yes.
Some of my life in this format, which I find it very interesting. Maybe we can do more in the
100%. And finally, you know, it's not just about on your videos. Sometimes I see like spreadsheets and data and slides. Now at least I get to know you, you know, as a person as well. All right, guys. Hope you enjoyed the video or the podcast. As usual, if you are on YouTube, you should know we are on Spotify. If you're on Spotify, you should know we are on YouTube as well. Go follow both of these channels so that you can listen to some of our other podcasts. And I hope you enjoyed this session, and we'll see you in the next one.